Let's get right to it. Fixed income investments are essential for anyone serious about building lasting wealth. They may not be flashy, but when markets get rough, fixed income is your safety net. Think of it as the bedrock of your financial house: solid, reliable, and crucial. Why fixed income? 3 reasons: predictability, capital preservation, and stability. You get steady returns, protection for your hard-earned money, and a buffer against wild market swings. This isn't about chasing big gains, it's about sleeping well at night. If you think fixed income is complicated, don't worry, we're breaking it down today. We'll cover what these investments are, how they work, and how to use them wisely. My goal: give you the tools to make fixed income work for your financial goals. So grab a pen, this is one lesson you can't afford to miss. Let's start with the gold standard, U.S. government securities. These are the safest fixed income investments backed by the full faith and credit of the U.S. government. There are 4 main types: Treasury bills, T-bills, Treasury notes, T-notes, Treasury bonds, T-bonds, and Treasury inflation-protected securities, TIPS. T-bills are short-term, maturing in a year or less. You buy them at a discount and get the full value at maturity. T-notes are mid-term, maturing in 2 to 10 years, and pay interest every 6 months. T-bonds are long-term, maturing in 20 or 30 years, also with semi-annual interest. TIPS protect you from inflation. Their value and interest payments rise with inflation. Why are these so safe? The U.S. government can tax and print money to pay its debts, making default risk nearly zero. The main benefit: capital preservation. If you need your money to be there when you need it, treasuries are your friend. The trade-off? Lower returns. Safety comes at a price. And watch out for inflation. If your bond pays less than inflation, your real return shrinks. Treasuries are the foundation for a secure portfolio, but you need to understand the risks and rewards. Don't just buy them because they're safe. Know how they fit your goals. T-bills for short-term, T-notes for medium, T-bonds for long-term, and TIPS for inflation protection. They're not exciting, but they're reliable. Use them to anchor your portfolio, especially when you can't afford to take big risks. Remember, safety is great, but always consider the impact of inflation and low yields. Mastering these basics is step 1 in fixed income investing. Now let's look at options with a bit more yield. Next up, Ginnie Maes, or GNMA securities. These are mortgage-backed securities, guaranteed by the U.S. government. When you invest, you're buying a piece of a pool of home loans, mostly FHA or VA mortgages. The big advantage: if a homeowner defaults, the government guarantees you'll still get your principal and interest. That's why Ginnie Maes are considered very safe from credit risk, yet they usually pay more than treasuries. So, what's the catch? Prepayment risk. If homeowners refinance or sell, you get your money back early, often when rates are lower, so you can't reinvest at the same yield. If rates rise, you might be stuck with a lower-yielding bond while new ones pay more. Ginnie Maes pay monthly, which is great for steady income, but the amount can vary. They're generally liquid, but not quite as much as treasuries. Most investors buy them through mutual funds or ETFs for diversification. Bottom line, Ginnie Maes offer higher income and government backing, but you must understand prepayment risk. If you want monthly income and can handle the uncertainty of prepayments, they can be a smart addition. But don't go in blind. Know how interest rates and homeowner behavior affect your returns. Ginnie Maes aren't set it and forget it. They require attention. Knowledge is your best defense. Let's talk about earning 5% or 6% on bonds. It's great, but don't assume you have to lock up your money for a year or more to get it. The key is efficiency. Make your money work smarter, not just longer. Don't settle for low yields on long-term bonds if there are better options with similar risk. Consider short-term corporate bonds. Higher yields than treasuries, but stick to investment grade and short durations for safety. Municipal bonds are another option. Their interest is often tax-free, so a lower yield can actually mean more money in your pocket after taxes. Always compare after-tax, after-inflation returns. Bond ETFs and mutual funds offer instant diversification and professional management, making it easier to access a range of bonds. You can adjust your strategy quickly, move to shorter durations if rates are rising, or seek higher income if you're comfortable with more risk. Use strategies like bond ladders to manage reinvestment risk and keep your money accessible. The point: don't just accept a yield. Analyze how long your money is tied up, the risks, and the real return after taxes and inflation. Be active, not passive, in your fixed income approach. Always ask, Is there a smarter way to get the return I want, with risk I can handle? Don't let your fixed income portfolio be lazy, optimize for your goals. Real returns matter more than headline yields. If you're strategic, you can earn solid returns without taking on unnecessary risk. Challenge conventional wisdom. Don't just buy and hold forever. Use the full toolkit. Treasuries, Ginnie Maes, corporates, munis, funds and ladders. The smartest investors make their capital work efficiently. Don't settle for less, demand more from your money. That's how you build lasting financial security. We've covered a lot, now it's time to take control. U.S. Treasuries are your safety net, but watch for low returns and inflation. Ginnie Maes offer higher income, but you must understand prepayment risk. Don't just accept returns, balance yield, risk and duration. Explore short-term options, consider tax benefits, and use funds for diversification. Always focus on real returns after inflation and taxes. Fixed income doesn't mean fixed thinking. Stretch for safety and growth. Make smart choices and let your money work for you.